Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by Alan Higgins. And to mark the publication of Coutts Outlook 2024, we're also joined by Coutts Head of Asset Allocation, Lilian Chovin. Welcome, Lilian.
Welcome. Hi, I'm very excited to be here today. Thanks for having me.
You're very welcome. And we're looking forward to getting, from you at least two of the things we need to know from the Coutts 2024 Outlook, because the rules are, it's two things from our guest and one thing from Alan. But before we get to that, Alan, a couple of things we need to just catch up on. You were picked up on something you said last week. We did a very interesting episode of Need to Know with James Butterfield from CoinShares to discuss the launch of the SEC ruling, the fact that you could have Bitcoin ETFs in the US. And there was a bit of a challenge from one of our colleagues at Coutts about whether or not a UK investor could actually buy a US Bitcoin ETF. What was the upshot of that?
Yes, Sarah, and welcome, Lilian. Look forward to talking to you later. So, yes, we'll name him, shall we? Richard. And he's quite correct. So, because our listeners may be puzzled when they look through the likes of Hargreaves Lansdown and AJ Bell, where is this Bitcoin ETF? And the other platforms are available, I should say. And he's right. In general, UK retail investors can't buy any US listed ETF easily on a platform. However, if you're high net worth or a professional investor, then US ETFs, including the Bitcoin ETFs, are available to you. And I think we weren't crystal clear. And Richard is a stickler for detail, isn't he, Sarah? We know him well. So quite right that he came on and put us right. So so if you do want to join the crowd and buy one of these, was it 11 that James said? 11 Bitcoin ETFs.
It is 11, yeah.
You need to be either a professional investor or a high net worth investor based here in the UK. And no taxation advice, but I believe with US listed ETFs, the taxation's a bit of a nightmare as well. So best talk to your private banker, hopefully a Coutts one instead.
Yeah. And we're certainly not advocating professional investors or ultra high net worth individuals go off and buy US based ETFs. But it was just for clarification on what you said last week. And thank you very much, Richard Woodrow, who I'm sure we're going to have on Need to Know fairly soon, actually, talking about something or other. But that was good to clear that one up. Thank you. So, Lilian Chovin, welcome back. Now, you have been on the podcast before, but it was a long time ago, before the days of Spotify and Apple. Before we get to your two bits from the Coutts 2024 Outlook, I think it'd be really interesting to just, for those perhaps that don't know you, to just tell us a little bit about where you've come from, how you got into the world of investment. You're French, obviously, going by that name of Lilian Chovin. So how did you end up in London working for Coutts?
Well, that's a long story, but I'll keep it short. So I started my career. I'm very fortunate to have worked in very different institutions, I must say, managing money in different type of businesses. I started my career in a boutique hedge fund, so very much focused on shorter term strategies, a lot of pressure, a lot of quirks about that world. I then moved to work in a large UK corporate pension scheme, so much longer term, very institutional, lots of different types of investment that are not available for retail, for example. And then I moved to Coutts about 7 years ago, and I'm currently responsible for asset allocation. So I sort of oversee all the research that we do that leads to having good challenges, good discussion, and good investments down the line.
And how do you find being based in London? I mean, were you based in Paris before, in the earlier part of your career?
Yeah, I actually never worked really in Paris. I did an internship there for a year. So all my working experience has been in London. I'm loving it. It's a great city, very cosmopolitan, not too far from France as well, which is convenient for holidays and travel. But it's great. Loving it.
Okay. And one final question before we get to the actual serious matter of Need to Know. Alan and I have been having discussion about the various merits of surfing on the Gower Peninsula or Cornwall. What's the best surfing beach in France?
That's a great question. Yeah, I heard you guys discuss that last time. So obviously Biarritz is one of the most famous place. I actually I actually looked it up, and it happened to be the first place in Europe where surfing started back in the 50s. And obviously the other big French place for surfing, it's not technically France, though it's part of France, it's a French territory, is Tahiti, where the Olympics will take place, surfing competition will take place in Tahiti. So we have quite a few good spots, maybe not as well known or as well appreciated as Cornwall or Wales, but still decent.
Okay, well, let's get on to the serious matter of 2024 Outlook. So now, for those of you that wanted to hear perhaps what some of the other big investment houses have been saying, you can listen back to our episode from the 3rd of January when Alan did all the research so that we don't have to. But Lilian, what are your two sort of key things that investors need to know looking for the year ahead of 2024?
Yeah, so the two things which are on our radar and I think are worth discussing are one, small caps. And by small cap, I very much include mid cap into the mix, basically not large cap. And then I'll talk about government bonds and corporate bonds. So basically the fixed income universe. And those two areas are quite different. Different drivers explain performance, but they're both very interesting. And they should be quite interesting this year in 2024. So small and mid caps, typically we're talking about companies with market caps anywhere between a few hundred millions to 10 to 15 billion. So it's quite a wide range. It's not that small, but it's not exactly that big either when you compare them with, those huge, large US companies that have a market cap of 1 or 2 trillion. The larger one these days, that's the numbers you're talking about.
And are we talking about global small caps? Are we talking about US small caps? Is this sort of geography agnostic?
Yeah, so there's a lot of similarities across regions. So when we talk about small cap, I tend to think about the entire universe. But here, for the sake of the argument, I will focus a little bit more on US. It's just a deeper market. And, this is one market where you actually can distinguish, between mid cap and small cap, and you have slight differences, which I think make it more interesting for the audience and even for investors, generally speaking.
Is it fair to say that then, I guess, is part of the attraction of small cap in 2024 because we're seeing interest rates probably going to start coming down at some point this year, and it's perhaps a more attractive environment for those kind of companies?
Yes, that's part of the argument. So if you look back a little bit at why people get interested in small and mid cap, is obviously that size premium concept. So people are investing in smaller companies in the hope that they're going to grow over time and they're going to become large cap and maybe mega cap, and therefore you're gonna ride that growth over time, and you're going to get overcompensated for holding them. And there's a lot of academic debate around that. Some people argue there's a premium. Some people argue it's not. It's actually liquidity or another type of risk you're taking. We don't really think too much about those issues. For us, small and mid caps are an asset class on their own right? We think of them, in the same way as we look at large cap. We look at valuations, we look at earnings, we look at sectors exposure, regional exposure. Basically, what do you get when you buy a US mid cap or UK mid cap, for example? And typically, just to start the conversation, typically, and that's true for US but also UK, mid and small cap, they are typically overweight cyclical sectors and underweight tech, especially in the US. It's a big deal because basically you end up with less exposure to one of the key sectors of the past 15 years. So, when you allocate to that, you have to be very cognizant. It's more cyclical. So it's going to be more sensitive to the business cycle, but also, you don't have the tech exposure. So it could be a big drag depending on what tech does. Certainly last year was one of those years where not having tech wasn't great. Was better the year before, but basically that's what you have. Otherwise, together with being more sensitive to the business cycle, and that's going to be quite intuitive, smaller companies tend to be lower quality, lower cash rich than large companies. So they tend to be more sensitive to a widening in credit spreads, so basically to a deterioration in economic activity. So those are the things we should be aware of when we think of smaller companies, generally speaking.
Yeah, I mean, and you talked about, small caps are attractive because people want to sort of get in on these companies that will hopefully turn into mega cap companies further down the line. But how many of those small cap companies are actually companies that are on the way down? And do we filter those out? Because obviously they're not all the ones going up. Some of them are ones that have dropped out of maybe the S&P or the FTSE 100.
And that's a very important point, because obviously you have a lot of so-called zombie companies into that universe, companies that are on the way down, companies that are not profitable. There's an interesting thing here about index construction and benchmark construction. So when investors think about US small cap, they basically usually think about the Russell 2000, which is a very large, very well-known index, which represent that small and mid-cap universe in the US. The issue with that universe is that it really doesn't have any filter. So, you end up with a lot of unprofitable biotech companies, whereas you have another type of index, which is from S&P. So you have the S&P 400, so S&P mid-cap 400, and then S&P small-cap 600, which actually have a hurdle on earnings, trailing earnings hurdle. So basically, it screens out companies that are structurally non-profitable. And you tend to have an index or a benchmark which inherently is higher quality and is probably more representative of the investment opportunity that an investor faces when considering small and mid caps.
And how different then is that to the makeup of, say, the FTSE 250 as far as size goes, as far as type of company goes?
So it's interesting because I mentioned that mid caps tend to be more sensitive to the business cycle. Another point which is particularly relevant to the UK investment universe is small and mid cap tend to be more domestically exposed. Right. And so there's a lot of investors who actually would argue that the FTSE 250 is a better representation of an investment opportunity in the UK than the FTSE 100, which is composed of a lot of very large multinational companies, which don't really make a lot of revenue at home in the UK. And so in the past, a lot of investors have looked to the FTSE 250 as a way to gain exposure to the UK market, to the UK economy, in a way.
Okay. So sorry, Alan, you wanted to say something.
Yeah, I've looked at this. Very good point, Lilian. And yeah, the FTSE 100 is notorious. It's just I have the numbers to hand, and I'm sure you know them as well. It's basically circa 80% of revenues of the FTSE 100 overseas, but it's still reasonably large. 55% of revenues overseas for the FTSE 250. It is more domestic. It is more UK orientated. You're absolutely right. But it's still, surprisingly international companies. And it's been a horrible area, hasn't it, Lilian, for the last 2 or 3 years, the FTSE 250, after really 20 years of very strong performance. And that's one of the puzzles, I think, which we may have to come back to, is after stellar earnings delivery over 20 years of the FTSE 250, it's really dissipated away in the last couple of years, and it's really been a poor market to invest in.
Yeah, absolutely. And that goes to my point about why we're looking at small and mid cap this year and what could actually happen that would make the asset class perform better against large cap. You're right. and this is something that also happened in the US, by the way, you have a shift post pandemic. So up until pandemic, and basically from the great financial crisis up until 2020, earnings of mid cap have been very, very strong. They've grown on par with large cap in the US, which is quite a feat, and they've grown much stronger than large cap in the UK, and that coincided with very good performance. Since the pandemic, the relationship and the trend on earnings broke down completely, and it's been very weak. And as a result, smaller companies performed quite poorly compared to large cap, and the related valuation is at record high. So smaller companies are record cheap versus large companies, both in the US and in the UK, and probably other regions too. So the valuation element is clearly indicating that there's an opportunity here in that segment of the market. I'm going to give some numbers. For example, mid cap in the US trade at around 15 times earning forward, compared to 20 for the S&P 500, so large cap, and it's a pretty attractive ratio between the two, and that follows a roughly 15% underperformance for US mid cap versus large cap over the past 1 year alone. So the valuation element is quite compelling, but obviously, as always, you need earnings to deliver. The earnings is what you need to see grow for that investment case to turn out profitable, and it's not the case yet. And we're waiting for evidence that segment of the market, starts growing its earnings again, and that would probably be a good catalyst for some re-rating to take place.
Okay, so essentially, then we're talking about here small and mid cap companies. They're on our radar, but it's on our radar at the moment. They're not something we're about to sort of dive into. A lot will depend on those earnings have got to deliver. And I guess presumably we've got to see interest rates start to come down to make it a more attractive environment. And generally they just need to be in the sort of positive sort of part of the business cycle for those small and mid caps to do well. Is that fair to say?
Yeah, so there's two things that have been headwinds to small caps. So the first one obviously has been rising interest rates. I mentioned that those companies tend to have weaker balance sheets compared to large companies. So obviously, the rising financing cost, rising interest rates hasn't been great. And, they've struggled. I mean, some of them have struggled because, it takes a very strong cash position to fare well in that environment. And a lot of those companies don't have that. The other interesting part, I would say, which is another way why small and mid cap could be interesting, especially in the US, is, we've mentioned a lot the Magnificent Seven and that concentration at the top of the S&P 500. There are a few ways to try to diversify from that. So some people look at the S&P equal weight and as a way to not have these excess exposure to those very, very large stocks. Actually, when you look at relationships between different indices and the S&P, the equal weight gives you a slightly similar exposure than having a small and mid cap index. The difference, obviously, that we believe small and mid cap is probably a better investment because you're buying companies that are hopefully, if your investment thesis is correct, are going to grow, and so they're going to represent a growing weight in the fund or in the benchmark you are buying. Whereas an equal weight, obviously, you're basically holding the same weight, going forward. So you're not benefiting from that natural selection where winning companies are gaining are becoming more and more important in your portfolio. So there's two ways to address, or probably more ways to address that concentration issue in US companies, and mid cap is probably a pretty good one when the time is right. And we think, some elements are there, the valuation definitely. As far as the cycle is concerned, there's a good chance to have a soft landing. Alan mentioned that last time. I mean, we're in the soft landing camp as well. We just need to see the evidence that earnings of those companies are on the uptrend again, because that would really reconcile and make us more confident that investment thesis is correct.
Yeah, I just thought we'd jump in there. I think Lilian's quite right, and it is an interesting contrast, the equal weighted versus kind of a pure mid-cap exposure, because the equal weighted, in a way, look, it can be good, but it's kind of a negative way of investing. It's definitely selling momentum, because the way to think about it, instead of owning Microsoft and Apple at their 7 and 6% weightings, great companies, you're basically saying they've got too expensive, maybe they have, who knows, and they're now represented with a 0.2% weight. So it's kind of a big negative bet on the Magnificent Seven, whereas finding either on an index basis or the right active mid-cap manager, it's a more positive way of playing this theme. So it's two different ways of doing it, but yeah, I think it's right to make that distinction.
Okay, all right then. Well, that's our first point then. So that's on our radar for 2024, small and mid-cap. Now, bonds. You want to talk about bonds, Lilian? Now, we've got bonds already in portfolios, but what specifically are you looking at in 2024?
Right. So bonds, obviously, it's a very vast universe. So I'm going to talk about both what we call the defensive type of bonds, so typically developed government bonds, and maybe some part of the investment grade universe, so some credit. And then at the other end of the spectrum, high yield, so those lower rated corporate bonds, which currently offer a pretty decent yield. Overall, the fixed income complex, is in a very different place than it was 2 years ago, before, the Fed started hiking and before we had that huge rise in inflation. And that's very important, because bond investing, I mean, I'm sure Alan will agree, it's all about math, right? I mean, you have a yield, you can sort of build a matrix of expected return depending on where yields go and how they move and whether that move is parallel or not. But in a nutshell, it's pretty intuitive. And so when you're starting, when your level of yield at the start of your investment period is 1%, your cushion, your buffer is very low. If you think about a fixed income asset, the total return you should expect is going to be decomposed or broken down into two parts: the income component, which is your yield, effectively, and then how that yield is going to change. So that capital gain or loss, which results from yields moving up or down. Obviously, when you start from a yield of 1%, your return is going to be dominated by what happens with that yield. Is it going to go up or down? That's going to drive your total return at the end of your holding period. We are today at 4 to 5%, maybe even more, if we speak about high yield. So basically, that's your buffer. For that to be wiped out, it takes a lot of move on yields to remove that. So there's, we have much greater confidence today holding some bonds, almost regardless of what our view on inflation is. Obviously, that's going to matter a lot. If inflation, if you have a resurgence in inflation and yields back up, it's not good for bonds. I mean, we all know that. But in the grand scheme of things, it's, we're not going to have a repeat of what we saw in 2022 in terms of return on those bonds, simply because we're starting from much higher levels of yield. So I think if I have to think of bonds, and again, and similar to small cap, I would say the valuation element is there. So it's much more comfortable investing into asset when you know that you have that cushion, that buffer provided by attractive valuation. Then you can focus on, what's going to happen forward looking, earnings for small cap, yields, inflation, growth for bonds, defaults. If you think about high yield, then you can focus on that, but at least you're protected in a way by that level of yield. So we obviously think there's good opportunities in the bond market, in the bond universe, and our view, which is yes, we are seeing disinflation stall a little bit at the moment, but the levels, importantly, the levels of inflation that we've reached are a game changer. It's very different. It's very different to have inflation at 6 or at 3, and that's gonna be very different for the outlook of those instruments.
I think Alan wants to jump in, and then I've got a question for you. Go on, Alan, you go first.
Sarah, I may be stealing your question, so apologies if I do. But first thing I wanted to point out is that we're very much a global bond investor rather than a UK investor these days, and that was a successful switch made by the team some 18 months ago now. But I think it'd be useful. I mean, we have a wide range of listeners on this call from experts. I was talking to a CIO today who said he really enjoyed this call. He said it's the best in finance. Thank you, Ed. You know who you are. But Lilian, let's take
review, please.
Yes. German and French government bonds. The yields look low, right? 10-year yields at 2.25. I know the answer, but from a sterling base, maybe you can bring it alive. How can 2.25 and a little over 2.5 on French bonds be attractive from a sterling base? And maybe you can just explain how that works.
Yeah, I try to explain clearly. If I don't, please correct me. So basically, when you invest in the fixed income market, you tend to hedge your investment. So you hedge the currency of your investment, and that's because as I mentioned, a lot of the return from fixed income is derived from the income you're making, and therefore you don't want currency movements to dominate that return, because that would be very unfortunate if you buy a bond yielding 2.25%, and then euro sterling moves by 2% the wrong way, and then you end up with no money made on that investment. So typically, sterling UK investors would hedge any investment in developed markets bonds, whether it's government or credit. And so the hedging, what is interesting is that we tend to think about hedge. When you hedge something, it has a cost. Sometimes it has a negative cost, if I can say. So you basically have a windfall gain from hedging, which is the difference in short-term interest rates between the two regions. So currently, if I take a French government bond yielding 2.5%, that's going to be my return for a French domestic investor. But if I'm a UK domestic investor, I'm hedging that return back into sterling, from euro to sterling. I'm actually going to get, 2% more, Alan?
Exactly. You pick up the interest rate differential, which is important. And so these European government bonds on a hedged basis into dollars and sterling look very, very attractive. Look, these things can change, but I just wanted, our clients to know that, but also it's worth knowing is that just because yields are low, when you hedge it out, you have a higher. You can call it in synthetic yield. You pick up the yield. Yeah, I like the way you explained it. You used a double negative. Did you say? Well, to make it into a positive, it is definitely a positive.
Well, I think people have to think about it like that, right? I know it's not the same. I mean, French debt is definitely riskier than US debt or maybe UK debt. I'm not going to get into that, but it's very highly rated developed country government debt. There shouldn't be a huge amount of difference in the return you can make without any currency risk, right? And there's a sort of arbitrage that you shouldn't be able to make. So if you're getting 4% in a UK government bond, you should be getting the same ballpark number from a US one, from a Dutch one, from a French one.
Exactly. There are some bond markets that have an element of credit risk, famously Italy, and of course, years back, Greece. Interestingly, not now. everyone loves Greek debt now. I should say there's tiny, less than 0.1% Greek debt in the Coutts portfolio, just in case people have memories from 12 years ago or whenever it was. But Sarah, you had some questions, didn't you?
Yeah, I just wanted to ask, because I mean, obviously at the moment we're focusing on that sort of more defensive sort of side of the spectrum as far as bonds go, and government bonds. And I mean, traditionally they are seen as a flight to quality, which we perhaps saw less in 2023. Are we saying then that in 2024, those government bonds, those sort of low yield bonds, are going to perhaps take on or go back to their more traditional role?
Yeah, so that speaks about the correlation between equities and bonds. So traditionally, they are negatively correlated. So when equities sell off, people tend to buy government bonds as a defensive asset. And that's very useful for multi-asset portfolios because you have this diversification embedded into the product. It didn't really work in 2022. We know why. Importantly, we understand why that is and why it was in the past as well. And that's an environment basically where you have rising inflation, rising interest rates, and pretty weak growth. That is not an environment we anticipate to happen this year, certainly. So we would expect in some risk-off environment, if stress or if sentiment was to get negative again, we would certainly expect government bonds to behave the way we expect them to behave, which is in a defensive fashion.
And what about the other end of the spectrum? Because obviously the riskier you get, you're getting closer to something aligned to equity risk, aren't you? What's our view on those kinds of bonds?
Yeah, so the high yield market is a very interesting market, ever changing. The composition, the nature of companies that issue that type of debt is very different today from what it was 15 years ago. So we always talk about, high yield as one asset class, but really you have to understand what you're investing in today, because it's not going to be the same as what it was 10, 15, 20 years ago. We think yields on offer at the moment are pretty decent, high single digit. That's mostly driven by the risk-free component. So if you think about high yield, it's the yield you're getting is, you can break it down between a risk-free component and then the spread on top of that, which is to compensate the investors for the risk of the company defaulting, because there is a risk, obviously, and some of those companies do default. But we think when you account for everything, we think high single digit is pretty decent in a world where growth is benign. There's good chances of having a soft landing, and central banks have paused their hiking cycle. It makes sense to actually try to clip that coupon. And lastly, but not least, net issuance. So, how much, basically supply and demand, any market, when there's a lot of supply, you need buyers. And so if you have a lot of supply of bonds, you need a lot of buyers to balance the market. The good thing with high yield is that net issuance is very low, maybe even negative. So basically, it's not very demanding. You don't have a lot of pressure. You don't need a lot of investors out there to balance out the market, which is a good thing for 2024.
And how is the liquidity compared to government bonds? Is it an equally liquid market?
It's a fairly liquid market, nowhere near as liquid as a government bond market, obviously, but it's not that bad. And obviously, depending on how you access the high yield market, you can get more or less liquid instruments and vehicles. And we just to talk about how we invest in high yield at the moment is through the more liquid way, through CDS, because we think at the moment, given some of the risks that exist in the market, is probably the safer way of expressing that view.
Alan, you had a question.
Well, I must help. So CDS, our fellow CIOs listening and other investment professionals, no problem. But CDS, what's Lilian talking about is think about it as basically on an index basis, synthetic index, like a future for bonds. They're called CDS indices, and Lilian's quite right. They're super liquid. And yeah, just on high yield, just thinking to what Lilian says, composition is exactly right. The composition has changed so much. I've been involved in this market, you know, for 30 years as a bond buyer. It used to be so low quality, and it's very high quality now. And what it's really one of the kind of unforeseen, basically conclusions of this big move into private debt. So a lot of the lower quality high yield debt, smaller issues, triple C is the lowest credit rating, which we used to see in high yield, dragging the defaults higher and dragging returns down, are now in the private debt market. Now, private debt, perfectly interesting area to invest in, but that's where all the money is now. And then the final point I'd make about high yield, in my experience, of course, it's super tempting, just like equities. We talk about this a lot, don't we, Sarah? Buy on a big dip. Yeah, of course it is. But just like equities, you kind of got to be in there and compound away. And yeah, we may well be in high yield, and we may, when there's a 10% correction, I say when, because there's nearly always a 10% correction in equities, high yield will go down a fair bit. But hopefully we've compounded away that income stream. And once you extend your time horizon, especially over to 3 to 5 years, the compounding effects at high yields at current yield levels will be very powerful. But look, just like equities, it'll be a little bit more of a rocky ride, but you know, a very interesting strategy. I was very pleased to see the strategy team include that.
Yeah. So is it fair then to summarize then that as far as the outlook for bonds for 2024, we're saying that the sort of lower risk government bonds we think we're going to see that return to that negative correlation between equities and bonds, where when one goes up, the other one goes down, which we haven't seen in the past year, or seen less so, certainly in 2023. And we're seeing high yield debt as attractive because those yields are looking very good, and you basically wanted to lock in those high single digit yields. Is that a fair kind of summary of what we're looking at the moment? Yeah,
I think valuations are there, and if you know, even if inflation doesn't collapse from here, you know, even if yields remain where they are, you're going to clip that 4% on government, and you're going to clip that 8% on high yield. So I'm not saying you're going to get, you know, you're not going to double your money with bonds. It's not what I'm saying, but it's pretty decent. It's pretty good for, in the context of other investment, it's pretty good. Okay. All right. Thank you very much, Lilian. Well, thank you very much. And do feel free to jump in when Alan's now, we come to Alan for his final point, which is your sort of third takeaway from the Outlook 2024. And it's one of your favorite topics, Alan, isn't it?
Yes, I was actually thinking, you know, people saying, oh, not again. He's not talking about active versus passive again, is he? So I'll try to be fresh about it and a bit more specific. And again, for newer listeners who probably hear, or everyone's talking about active versus passive, you've got to bear in mind that we launched a product 12 years ago that had passive as one the absolutely main building blocks. So if anything, we're known as an index house rather than an active house. But before I get to kind of the future, I would say last year was incredibly tough for many of the reasons you heard from Lilian, because especially in the United States, but the dominance of the so-called Magnificent Seven. But as Lilian's here, fair play, at least for us, it wasn't too bad active management, was it, Lilian, last year?
Yeah, it was pretty good. And, you know, by no means, you know, it's like that every year, but we had a good portion of the third-party managers that we pick and we include in our portfolios outperforming their benchmark, despite, you're right, having such large gains by those Magnificent Seven. So it's a pretty strong performance given the circumstances.
Anyway, we're not here. Sorry, we're not here to sell Coutts, are we, Sarah? Go on, jump in.
No, we're not. No, but I was going to argue, is it not fair to say that when you've got something like the Magnificent Seven that dominate an index, does that not perhaps then give greater scope for outperformance of some of the sort of overlooked stocks, because they're probably a bit cheaper than perhaps they should be, which then gives greater opportunity for active managers?
Yes, going forward. But if you missed out on these Magnificent Seven last year, you had to do an incredible job. And as Lilian said, our partners did a pretty good job. And, why don't we? A shout out to the Coutts Fund Selection team as well. Did a, really, really good job there. But yeah, going forward, that's why I made the call, wasn't it? And in November, the contrarian instincts got me going with the concentration of the Magnificent Seven and seeing elements of the asset management industry almost give up on active management. Just a bit of data, because I'll be brief just to finish, because I did write this piece. I think Lilian and his team did most of the writing, but this is one little piece I did write. So for me, the best source of data is Spiva, which is a division of the S&P. Some investment banks also do this, and they show it was tough last year. Spiva, it's great data because they take out survival bias. What does that mean? That means, a fund that may not have been so good all of a sudden disappears. Well, you need to include that because you could have invested into that. And they're very, very precise on fund versus the right benchmark. And just as a reminder, so that the last data is quite out of date to June 23, but over 5 years, 87% of US managers underperformed over 5 years. It's been really, really tough. So we're making this call, and where could it go to? Well, to give a flavor, I've said it before, it could go to where we are in active bond management. So I'll give you some numbers from Spiva again on active bond management. In high yield, which Lilian talked about, over 3 years, it's about a 50-50 game. So 50% of managers outperform, 50% underperform. And investment grade in the United States, actually, active does a lot better. It's basically 70-30, 70 outperform. So it's a big reversal. Now that's maybe maybe a bit of a special 3-year period. But what I'm basically saying is that these numbers, 87, by the way, it's similar for Europe and even in emerging markets, they move closer to 50-50. So we're making that call. And, what does it mean? I guess it means Lilian and the team will be looking more at active managers, because obviously when I wrote this, I made sure they were in agreement, and they are. And does it mean all the portfolio will be active? Definitely not. It's at best is a 50-50 game, one, and two, index orientated solutions are so cheap. So that's the way I look at it. I don't know, Lilian, do you have any thoughts longer term? Did your contrarian instincts get interested when you saw the headlines? They almost said in the FT, we give up on active management in equities.
Yeah, that's usually the time you actually want to do the opposite. No, I mean, there are very useful indicators out there which look at dispersion in return within a universe. And it's sort of pretty good at understanding whether it's a right environment for stock pickers, so for active managers, or not. And you can go and try to explain performance of a market and try to see if it's been driven by macroeconomic considerations, interest rates and stuff, in which case, it's not going to be really an environment for active managers because it's not their job. Or if it's an environment or if the performance of the stocks of a market are being driven by bottom-up fundamental considerations, earnings. And that's an environment where you would tend to see active managers do quite well because it's their job, right? Assessing which companies are going to grow faster than the rest of the market. And it looks like we're getting into that environment, which should favor active managers a little bit more than it has in the past. So hence why we are looking increasingly at active managers, and why we think it's going to become increasingly an environment for those type of investments.
Alan, I've just got one final question for you before we sort of close. Why that difference then between the sort of relative success of active bond fund managers versus equity fund managers? Why is it easier to be a good active manager in the bond sphere than it is in the equity sphere? Don't tell me it's a theory.
There's going to be a couple of theories here. It hasn't always been in high yield. So high yield bonds has been fairly recent. The index has been king in high yield for many, many years. In investment grade, what you tend to see, so it's simple, over the longer term, 3-5 years, take more risk, earn more return. So investment grade managers do have a little bit of a high yield in there. That has worked, so that has helped them. So you can it's called style drift, but look, it's part of their mandates. They're allowed to. But fair, it's always good to give me some homework, Sarah. That sounds like homework, and I'll be talking to the fund selection team here at Coutts and elsewhere. So I'll come back to you on that, because I think it is an important point. Why does this data look a lot better for bonds managers than it does for equities? I suspect it's to do with the extraordinary circumstances we've been through in equities. But let me do some work, and I'll come back for a future need to know.
Okay, I'll be reminding you of that. Well, thank you very much, Lilian Chovin, for joining Alan and I today. So for those of you that want to read the Coutts 2024 Outlook in more detail, it's up on coutts.com now. Have a look at it. Come back to us if you've got any comments or questions, and I'm sure we'll have Lilian back on again soon. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. As I said, thank you very much, Alan and Lilian, for joining me today. We'll be back next week with more Need to Know. Until then, bye for now.